All right. Well, good morning or good afternoon, depending on where you're located in the U.S. today. Welcome back to Mortgage Law Today, our monthly webinar, web show, where we discuss everything mortgage law related. I'm Brian Levy, again, your host, and joined again by our panelists, Loretta Salzano and Peter Idziak, with our host sponsor, Polunsky Beitel Green, who we very much appreciate their sponsorship. Joining us today, our guest is Justin Wiseman, who is the Vice President for Residential Policy at the Mortgage Bankers Association. And I would say pretty much the top lawyer in the Mortgage Banking Association for the kinds of issues that we discuss here. Justin has been with the MBA, I'm going to say at least 10 years, but Justin, you can correct me on that. We're very much looking forward to talking about the upcoming Regulatory Compliance Conference, as well as a lot of other topics that we've got on our agenda. So without further ado, I'm going to kick things off and ask Justin to maybe give us a little introduction on himself. For the people that maybe don't know him, which I can't imagine there are many, but introduce yourself and maybe give us an update on what the MBA is up to, in particular focused on the Regulatory Compliance Conference.
Sure. No, thanks. I really appreciate that. And I'm excited to be on the podcast, a fan of the podcast and obviously of Brian's blogs. Though I should say I'm a fan of Brian's blog, but also a infrequent critic. But I do send him a note.
I love the feedback. I mean, you know, I wish more people gave me feedback like you do, Justin.
No, like I said, almost always good, but every once in a while. No, so I am Justin Wiseman. I am the Managing Regulatory Counsel and Vice President for residential policy at MBA. And I have the privilege to lead what I kind of call our federal facing team. So we're the team that works with government agencies, as well as provide support to our colleagues that do the day-to-day Hill lobbying. And also we handle the litigation support. So that's amicus briefs and the rare instances where MBA would be a direct litigant in cases. And that gives me a pretty comprehensive view into the issues that confront our industry, both on the regulatory side, but also on the litigation side, as well as on Capitol Hill. And that is what we try to bring our strength to bear and strength in numbers to bear to represent folks that are members of the association. You asked what our priorities are. I think we're watching a lot of things, and this is probably going to be the subject of our discussion, but it's certainly a really interesting time in DC. I'd be remiss if I didn't say we're celebrating a few successes. It has not been a great legislative environment for most things, but we're gratified to see two of the bills that MBA has really pushed and championed. The first one allowing a partial claims program in the VA, which they did not have previously. And the second, and perhaps more impactful to loan officers, is the dramatic curtailment of trigger leads, both being passed essentially unanimously in the House and Senate. And in the case of VA partial claims, signed by the president. In the case of trigger leads, soon to be signed by the president. So we're looking forward to that signing and celebrating those wins here at MBA.
Justin, it may be a sort of a Dumb and Dumber kind of question about, you know, is there still a chance? But is there any chance the president won't sign this bill?
So that is a question best left to our lobbying colleagues to give you the definitive answer. My understanding is this happened right at the end of the August recess, right, or right before the August recess. So they passed it through the Senate by unanimous consent. The August recess happened. It is not atypical for these things to take a little bit of time. I'll note that, you know, in the hypothetical world that he does veto it, you spin down into veto or not sign it, rather, you spin out into all different scenarios. But the first is, you know, for it to be a pocket veto, I think you need the Senate. Want to get this right. I think you need the Senate to be out of session, and the Senate is in pro forma session the whole time. So when it's conveyed to him, even if he doesn't sign it, I believe, and you know, folks that know congressional procedure better check me here because I'm not in my area of expertise, but I believe it becomes effective 10 days no matter what, because the Senate is still in pro forma session. But the second thing is, I mean, this passed both houses essentially unanimously. So I don't think there's any reason to think that that wouldn't then result in the signing.
Well,
Why don't you give everyone just a short summary of the Trigger Leads bill? I know that MBA has been really effective in communicating, but a lot of these bills are passing in states in less toothy manners. So I think it'd be helpful for everyone to understand what it will do when it becomes effective.
Absolutely. So the bill that just passed both the House and Senate essentially forbids the use of mortgage trigger leads. Hopefully everyone knows what those are, but those are when there is a credit inquiry, the credit bureaus would then sell leads to other people on the basis of that inquiry, right? It's Loretta was looking for a mortgage, she got her credit pulled. I'm going to sell her information to other people so long as they make pre-screened offers. And that was allowable under the pre-screened offer provisions in FCRA. Well, the bill that just passed changes that significantly. It says that the credit bureaus cannot sell a lead on the basis of a previous credit inquiry to anyone unless the following conditions are present. They make a firm offer of credit, so you still have to make the firm offer of credit. The consumer has consented to such an outreach, which allows for consumer consent, right? So people who want these could get them through consumer consent. It's the originator, the servicer, or someone who holds an insured deposit account for that consumer. So to break it down in simple terms, the only trigger leads you would now see are from the existing servicer, the current originator, and where you have a banking, account essentially. We think this makes sense because you preserve some element of competition, right? There is still trigger leads to provide that competition and the ability to shop to consumers, but no longer are people going to be deluged by 100 calls, some of which are scams or unethical, people masquerading as the original lender.
Yeah, I can tell you that I'm sure Loretta and Peter could probably tell you the same thing, that we've gotten a lot of calls over the last couple of years of what can we do about this, and how do we stop the trigger leads from, can we get our customers to sign something? Can we? I mean, there's just never been a silver bullet for solving this issue that satisfies the loan officers and the concerns. The phone calls immediately start the minute they take an application and pull credit. So. I'm sure that there's a lot of people that are going to be very appreciative when that stops. And we're already anticipating that. So thank you.
Yeah, no, and we're appreciative of them, right? It's people sharing stories like you mentioned that really did the hard work of persuading their representatives in Congress that this was a problem worth addressing. And our Mortgage Action Alliance was instrumental in that. The MOM members that took action really helped push this over the line.
And Justin, the consumer opt-in provision, has MBA sort of thought through how that might, actually make its way into the marketplace? Because I'm sure the credit bureaus, although they maybe retreated, tactically from this battle, are going to look for a way to, still be able to sell their offers.
So what's interesting about the way this bill is structured is the liability sits with the CRAs, right? It says they cannot sell a lead to anyone unless they have authorization. So you would think that would incentivize them to at least have some fairly strong procedures for making sure that they have some level of that authorization. The other important piece is, unlike the current FCRA requirements, which says, it's a pre-screened, so it's a firm offer of credit or you have authorization. This would require whoever gets authorization to provide a firm offer of credit. So you would think they would also want to vet the ability of whoever is purporting to have authorization to also make a firm offer of credit.
We do have a history, though, with the bureaus not doing a great job of compliance with their own rules on FCRA, like in terms of verifying debts, that are disputed. So is there any concern about the compliance issues, that if you do leave it up to the bureaus to get this right, that they might not?
I mean, I guess that's like a problem with passing any law, right? Like we pass the law, what if people, don't follow it? My response to that would be, I think FCRA is now past TCPA as the biggest cause of action on the plaintiff's bar side.
Wow.
Those numbers may have changed recently, but if it's not one, it's two. So there's a pretty robust private bar that I think would want to enforce this, and it would probably behoove them, particularly given the potential liability under FCRA for violations, to sort of try to comply here.
Great. Well, we had a little news last week in the CFPB staffing case. I guess it looks like that's going to be back in the court of the executive branch to decide who can be employed at the CFPB. Although they did sort of kick it to, I guess, civil service employment rules that still have to apply. Do you have any thoughts on where that's all headed, the CFPB staffing and that whole litigation?
Yeah, I think it's like the Merit Review Protection Board or something like that is like the civil administrative body. And obviously the court kind of punted a little bit on the merits to reach a standing conclusion. I think my overall intuition, and you sort of alluded to it in your question, is just given the current composition of the judiciary, at some point in time, if the administration wants to do a substantial reduction in force at the CFPB, that they will be able to do so. It's hard to see that, procedural complexity aside, when the dust settles, the conclusion will be no, the administration and the president is foreclosed from structuring an agency that post Salia law is explicitly now an executive agency. So I don't know exactly how the case shakes out. I won't venture a prediction on the mechanics of it, but I think the likeliest outcomes, if they want to continue to do a large reduction in force at the CFPB, that they will be able to do so.
So what's happening over there now? What are your thoughts or your perception about who's even on the payroll and what they're doing or how they might be redirected?
So I think that's a great question, and my former friends who have worked there and formerly of the bureau who've gone to private sector employment have rightly pointed out that irrespective of your views of the CFPB, I think we should have tremendous sort of sympathy and empathy for the people that work there. This has been a very disruptive and difficult process for them. So wherever the agency ends up, I think we should kind of have a thought for the people that are going through this now. To directly answer your question, there still are some folks there. There's been significant attrition due to the uncertainty. And I think that attrition, until we see kind of what the steps after the reduction of force look like, probably will result in a lessened capacity for the Bureau to do a lot of rulemakings, right? Pure rescission, like we're going to take down X rule, is probably pretty easy, right? You just say, for the foregoing reasons, we believe this rule is no longer necessary. But creating, let's call it, positive rules, like negative rules take things away, positive rules add things. Creating positive rules takes significantly more work. And a bureau that is substantially reduced, or a bureau that no longer has the subject matter expertise it had, 2-5 years ago, is probably less likely to be able to juggle multiple rulemakings.
Or even to change the things that MBA has been ardently advocating for. I mean, I know LO Comp was a hot issue for a while, and then all of the movement and all the great work that you and your committee did with Brian's help and others on RESPA reform that will require both congressional and or regulatory changes. So are those things DOA or just dormant, do you think, for now?
I definitely would. They're definitely not DOA.
Yeah, let's hope not.
Yeah, we care too much about changes to the LO Comp rule and changes to RESPA to ever let them be DOA. But I do think there will be a prioritization exercise going on at the Bureau. It looks like they're currently much more focused on open banking and those issues,
Right.
1033 issues, than they are on mortgage issues today. That's not to say there won't be a desire at some point to pick up mortgage issues. And we sent this out to folks that get our advocacy update on Friday. But we did have them post their spring regulatory agenda, and there were 3 items on it, right? An ANPR around the Reg X servicing rule, an ANPR around the LO Comp rule, which we would welcome, and then a possible rulemaking or item on ACOA. So though that went down, for the website went down for reasons we're still trying to figure out, assuming that is true and they meant to post that, that does show a willingness to address at least 3 issues in the mortgage space.
You know, you mentioned
Good. I need
APOR.
to, I'm a day late and $1 short on looking at those, so thanks for
Well,
the
if you look
prompt.
now, it'd be down, so you wouldn't see it. But we promise it was there for a period of time on Friday.
Great. Well,
Um,
that is, especially on LO comp, some people like throw out the whole rule, to your point of if they were just to take down a rule, and Brian and I have tried, and I think, Brian, you shared it in one of your musings that, that's not necessarily a great thing. You take down the rule because obviously we still have the statute, and then we're left with trying to figure out what we do with those broad brushstrokes. So there is some help in the rule, and
Yeah, I mean, I'd go
I'll
farther than you, Loretta. I'd say rescinding the LO comp rule without changing the underlying statute would be enormously disruptive
yeah,
to
I'm
the
with
mortgage
you.
business. I mean, people don't really remember this because it happened, but in the final rule, the LO comp rule, they allowed an exemption from the statute in instances where the consumer pays origination points and fees. They created an exemption to allow you to then pay the loan officer, right?
Right.
That's arguably not allowed under the terms of the statute. And that's obviously an extraordinarily common business model. So if one were to just wave the magic wand and rescind the LO comp rule, that exemption would go away, but the statute would remain. So we've always consistently said that it makes a lot more sense to amend the LO comp rule and to do so in targeted ways to enable better and more free competition rather than rescind it entirely.
Absolutely, but you hear people like with their sabers, and they just
Yeah, oh
don't
yeah, and I get
realize.
it. If you're not a lawyer, it makes sense. It's a bad rule. We should get rid of it.
Right.
The lawyer,
And Justin, to that point, in a sort of post Loper Bright and corner post world, is there any, focus within the NBA on working to change the statute itself? A new rule might be great, but then it gets challenged and, struck down. So I'm just curious about that.
So, yes, that is an interesting question. And we have, as I mentioned earlier, had some bipartisan success where there's agreement on the problem. Like, we need to have good tools to help veterans remain in their homes, or people should not be bombarded by harassing trigger leads. We were able to sort of get legislative solutions to those problems. My fear here is that this would be a much more partisan exercise. Elizabeth Warren is the leading minority member on Senate banking. Historically, she's been very proprietary of Dodd-Frank and unwilling to sort of countenance changes. So you'd really need a targeted bipartisan effort that also commands attention in a environment where we still have the NDAA, the Defense Authorization Act, to work on. There's appropriations issues. There's a lot of other things that could take up oxygen. So that's kind of a long and roundabout answer of saying that I think it's probably very difficult to unlikely to see statutory changes to a core part of Dodd-Frank right now.
I did hear something about a Dodd-Frank rollback bill that was being discussed. Do you have any intelligence on that? Or
So I know that there have been efforts to change and limit Dodd-Frank. My answer to Peter was assuming like a change to the LO comp rule that actually got signed into law. You certainly could see rollback bills in the House that would run into the filibuster in the Senate, right? Because we've already done reconciliation. You can't get things passed with 51 votes. So unless they get rid of the filibuster, and hey, who knows? We live in interesting times here in DC. But unless they get rid of the filibuster, you have to come up with a LO comp statutory change that would get enough votes in the Senate to overcome a possible filibuster. And that, to me, and I'm not a lobbyist, I work with our lobbying team, very frequently, but I'm not a lobbyist. That, to me, though, does seem like a very hard hill to climb, right, in this current environment.
Yeah, I think you're being kind when you talk about Elizabeth Warren being protective of the Dodd-Frank rules that she helped implement. I think I might use a stronger word about. I don't think she's open to discussion at all.
How about very protective?
Yeah, okay. I think we're on the same page there. Do you want to give a little bit of a highlight of what to expect at the Reg Compliance Conference next month?
Yeah, no, thank you. That's a great opportunity because we're really excited about the Reg Compliance Conference next month. It's September 28th through 30th here in DC. And it comes, as we've kind of talked in this discussion so far, at a really interesting time in DC. I think folks are going to get to hear from main policymakers from the administration, direct and in their own words about what their priorities are. But we'll also have really good discussions about how the changing environment has changed people's compliance responsibilities and obligations and how it hasn't, right? There's going to be a big focus on the shift to state level enforcement, state level legislative activity to try and step into a perceived void with the feds retreating. There's going to be a lot of discussion on what fair lending responsibilities look like, with fair lending being de-emphasized and deprioritized by this administration, but certainly picked up by others in the state space, as well as your usual panels on the state of the law around, RESPA, TILA, LO comp, recent developments and things like that. So we're really excited for it, and you'll get to see awesome speakers like Brian and Loretta. So that's also good too.
There was a great summary. You mentioned fair lending. Our last webinar talked about the ABA's white paper, which is an unfortunate name for something talking about fair lending, but their white paper on the premise of fair lending in the way that the Justice Department and the CFPB has been enforcing it. Is the NBA looking at that and in terms of a policy initiative, or is it just like, hey, you guys, we're kind of laying in the shadows here. We'll see how that plays out, because it's a third rail.
So I think it was a really well-written white paper. In many forums and in many venues, I think we've been consistent in criticizing at least how the Biden administration interpreted redlining. They converted what was once an affirmative choice to exclude communities, right? Classic redlining is, oh no, we won't lend here, into almost an affirmative obligation to lend in certain communities, changing it entirely. And that particularly is the case with some of the cases they brought against IMBs. So we are active in filing amicus briefs in those cases. We've certainly expressed our views to HUD with respect to the disparate impact rule multiple times, and continue to believe that the 2013 rule at least should be rescinded, as it doesn't properly reflect the subsequent Supreme Court case in inclusive communities. So we're very active on the fair lending side, and we do a lot. Although I have to give ABA credit for sort of pulling it all together, particularly with Paul Hancock's assistance, in a very sort of cogent piece.
Do you expect to have any, staying on the topic of the conference for a second, do you expect to have any CFPB speakers?
So I can't front run because it's not confirmed or announced, but I will speak cryptically. I think we will have someone from the administration who has significant insight into what is going on at CFPB. That is my hope, and we're close to that.
Excellent. And I'm sure, it doesn't take a genius to guess that you would very much want that to happen at any one of your meetings in Washington, D.C., where it's easy for them to get to. So,
oh, no, absolutely. And
I know many times you tried to get Chopra, and I think at one point maybe he was scheduled for one of the NBA meetings and then
He
canceled
was.
last minute.
So he did cancel for that, although I will give him his credit where he's due. He did come to our NBA secondary conference and speak there. He has spoken at our annual convention. So Director Chopra did not duck his critics. Whatever you may think of him, you cannot say he did that.
Speaking of directors of the CFPB, are we just not going to have one? I mean, what's happening with getting a director?
Would you do it, Brian? If asked?
Yeah, right.
Who's
You have
asking?
my vote.
Nobody's asking.
So I think the answer there, and this is kind of an intuition, is obviously Jonathan McKernan was nominated and then took the role as Undersecretary for Domestic Finance at Treasury. We haven't seen a nominee since. My intuition, and this is not having heard anything from any administration sources, but my intuition would be, I think it's likely for the litigation to resolve first before anyone becomes the director. I don't know that you would want to be the director that comes in and immediately rifts a large portion of the workforce, that maybe you let that shake out before we see a move toward a more permanent director.
Okay. Well, can we move to the GSEs for a minute?
Absolutely.
Now, a lot of news, I guess, not a lot of information, but a lot of cryptic kinds of pieces of information coming from the FHFA director, coming from the president himself about some kind of IPO. What does this all mean? Like, I recently read an article that Robbie wrote, Robbie Chrisman, that I thought was pretty interesting about that they didn't use language of this is going to be a secondary offering. They're talking about this is going to be an IPO, an initial public offering. If that's the case, we're talking about, I guess, wiping out the existing shareholders or giving them maybe something like Green Bay Packers stock, which is, you have stock, you supposedly own it, but you get nothing other than to attend a meeting once a year. What is the NBA saying, and what behind the scenes discussions can you share without being shot for giving up state secrets?
I always want to avoid that. So I think the most important thing to focus on, because you're right, it has been sort of interesting discussion and kind of varied points of view expressed on this. But the most important thing, or the most heartening thing from my perspective, is both Secretary Bessent and FHFA Director Pulte have repeatedly emphasized they want to do this in a way that does not roil the markets, does not have a long-term negative impact on either the market or on mortgage rates. And I think, to me, taking them at their word, that means they're likely to pursue a tempered path that does not result in the lot of dislocation you'd see if you were to simply go to an IPO without locking in the kind of reform necessary to ensure that we have the stable market we have today. And NBA, for example, has highlighted a few of those things, but that includes, making sure that any released GSEs maintain the current level playing field and don't do volume-based pricing discounts for certain issuers. But more importantly, that there's an explicit government backstop on the GSE MBS, right? Either structured through a revision to the PSPA or a line of credit from Treasury, or granted by Congress, but an explicit acknowledgement that these securities, not the debt, but the securities, would be guaranteed, because that really kind of underpins the market today. As to the IPO, it's hard to kind of parse what everyone's talking about, because they seem to also say that it will remain in conservatorship. So to your point about GSE, stock becoming like Packers stock, yeah, I mean, there's that 300+ billion of government senior preferreds out there. If they were to convert all of those to common, you dilute everybody. Like, everyone would get incredibly diluted under that. But if they convert a small piece of it, like 30 billion, and sell that while remaining in conservatorship, the math maybe is different. But then you would have to raise questions about, if I buy that stock while they're still in conservatorship and the return on and equity is probably lower than I'd get in the market, who's going to buy that? You've heard talks of sovereign wealth funds or selling it to foreign sovereign wealth funds, things like that. But I don't know that any of the plans that are public are mature enough to sort of know what the path would be for sort of what I'd call like a small slice or limited IPO. Finally, I'd recommend folks read Mike Frattantoni's recent interview, I believe, with Bloomberg on this, because he does a really good job of outlining our thoughts. And obviously, Mike is our chief economist. So,
Justin, do you think that we should, sort of read this as the first step towards privatization, or is it more, the administration sees a way to make money? Because, in other contexts that we've seen sort of increasing government involvement in private enterprise as opposed to increased privatization.
So I think the best way to read it now is a statement of intent that after 16 or 18 years of conservatorship, this administration is thinking seriously about how to end the full government ownership of the GSEs. And that's something NBA agrees with too, right? The conservatorship was never meant to be indefinite. To your point, what it means is a return to sort of private entities, which I don't think they'll ever be fully private, as I mentioned, because of the need for the explicit backstop, as we see important, or whether it is just a revenue raiser through a limited IPO. We need to see kind of where it shakes out. Mm-hmm. But certainly you could see a view where if they sell some level of GSE equity, they could also, book that as revenue against the budget deficit.
Yeah, definitely.
Yeah, Robbie's article called the common stock a litigation lottery ticket, and it may very well be that. But the interesting thing that he highlighted that I guess I hadn't really considered is back when they were brought into conservatorship, they were not put into what we would call traditional bankruptcy, or like an FDIC receivership, and wiping out the shareholders, on the premise that if they did that, then all the losses would have gone on the balance sheet of the federal government. And this way it was kept off the national debt, essentially. And so the question is, well, if you do create a new company or recapitalize it and then still have some kind of federal guarantee, what does that mean for the national debt, and how do you pay for that guarantee? I think those kinds of questions are really tricky. And people ask me, I was just somewhere this weekend with a bunch of very smart people, and they were asking me, well, Brian, what's going to happen with the GSEs? And I got to tell you, I do not have a good elevator speech for what's going to happen. I mean, it is a big quagmire.
And all my
you're
crystal
right that
balls
it
were
is an
so
orderly.
cloudy. I never thought it would last this long.
Yeah, I mean, I don't think when they put them in conservatorship, anyone thought it would last this long. To the point about revenue raising and things like that, I mean, there's different things to look at, right? Like I said, there's almost 320 billion in senior preferreds. There's also the GSEs sort of have to return the capital that was lent to Treasury, and as their capital grows, because the capital rule, that share that they have to return to Treasury grows. So there is revenue, in quotes, to be found from them exiting conservatorship, but it's not straightforward or easy to see how you necessarily accomplish it with the reforms that at least with the reforms that we think are important, and presumably the administration does too, given their stated desire to not interrupt or disrupt the market. I will push back a little bit on the complexity of the guarantee, though. I mean, because Ginnie Mae manages to accomplish it, and you do it through a G-fee, right? Like you could see the GSEs, if they were privatized or quasi-private, paying Treasury for the guarantee, and a properly scoped G-fee is functionally insurance, right?
Right.
Yeah, my thing would be, I think, any administration sort of, now that they're, they've gotten sort of a taste for controlling or, directing the housing market, that you really want to just give that up? Or, is there always going to sort of be some sort of like golden share or other federal control? Because if you, give up housing policy, a large chunk of it, to the private sector, that really takes away one of your levers of power as an administration.
Yeah, I mean, I think that's an interesting point. You certainly have seen they've suggested that the conservatorship may not end, but an important thing for folks to remember to that point, though, is that, like, let's assume a world where we solve all of the problems of how to get them out of conservatorship. You still have FHFA, right, who's a pretty strong and empowered prudential regulator. You'd have two, presumably private, hopefully with an explicit government backstop, but two explicitly private enterprises that are governed by a pretty strong and empowered prudential regulator. And what we need to think about as we think about GSE reform is, what does a post-conservatorship FHFA look like, and what sort of powers do they need in statute to ensure that the GSEs continue to do the market beneficial and other positive activities they're doing now under conservatorship?
There's another job for you, Brian, in case you don't want to be the CFPB director.
I'm just quite happy as the host of Mortgage Law Today. Well, I know there may be other things, Justin, that MBA is looking at getting involved, or maybe currently involved in, that you want to discuss. I'm going to give you one more
So
chance.
I think one thing that we need to talk about is credit scoring and credit reporting, right? Director Pulte obviously made his announcement that they will now begin the process of accepting Vantage scores for GSE loans. This is something we welcome. We've always been a fan of credit score competition, and honestly probably think that, it might be good to get FICO 10T and the most modern scores in there as well, so that we have both competition as well as the most modern improved scores. But Vantage Score is now the one we're implementing, and that, I think, is a positive factor. We've been engaged with FHFA, and we certainly appreciate Director Pulte's kind of willingness to cut the Gordian knot here and launch this process, because it's something we've been talking about for a long time. In our view, the next step, though, is considering competition around credit reports. So competitions and scores are great, but the need for the tri-merge credit report, arguably, and this is a conversation that's very robust right now at NBA, but arguably we don't need a tri-merge anymore. Could we get along with, as they chose in the previous administration, a bi-merge or even a single report, right? A lot of other asset classes lend billions and billions, it's probably trillions of dollars on the basis of single credit reports. And is it time for mortgage to follow suit? So that is a big conversation that's ongoing here at NBA, and our residential board of governors, which is sort of our highest policymaking body, just adopted a resolution essentially saying, it is time to end the tri-merge and let's look for viable alternative solutions.
Can you maybe talk a little bit about how things are different in Washington today in terms of accomplishing objectives? I know everyone, I mean, you were able to get the trigger leads bill through, which is incredible, but it took several years, and it was, a lot of blood, sweat, and tears. I see different tone of communications, different initiatives coming from NBA. Maybe if you could speak a little bit about how it is to work in Washington. Things may be a little different, and maybe where some people like the people listening to our show today can help as lawyers or as advocates for the industry.
Yeah, so that's great. And I'll take the last point first. I mean, the success of trigger leads, any success in Washington is built by advocates like us being able to say sincerely, this is a problem that matters to people back home, right? This matters to your constituents. This affects businesses in your district. So one thing that hasn't changed is being able to articulate and point to that impact, which we get through our members or our Mortgage Action Alliance members, either coming to us directly or communicating with the relevant constituents, is still really important. As for what's changed in DC, I think we are continuing, and this was the case in the last administration and then in the first Trump administration, and arguably in the Obama administration, to see increasingly polarized viewpoints in DC. And so that really requires deft coalition building, right? Which has always been important, but you really have to understand both the perspectives of your partners, but also the perspectives of people that may be talking to you and others that don't agree with you. So we continue to be engaged in that coalition building exercises. And then the last thing I would say that has probably changed, and everyone notices this, is we now have to be more attuned to being communicated with in different ways. I will say that we were not as avid Twitter readers 2 years ago as we are now, but that is a different form of communication, arguably a more mass media or mass friendly method of communication. More people probably get their news from Twitter than they do on the Federal Register, but it's been a change for us to try and keep up with regulatory pronouncements on Twitter.
I feel like NBA has really changed the way it communicates to its members too. To be, you were always informative, but I feel like you've upped your game by providing different education tools and information tools, and maybe tooting your own horn more than you had in the past, especially on advocacy wins like the trigger leads bill. And so good for you on that.
No, thank you. I appreciate that. It is our goal to communicate with our members in a way that is interesting and informative to them, right? We know they hear a lot of different voices, so we want to make sure they hear ours and hear what we have to say. And as for tooting our own horn, I mean, I keep coming back to this theme, but it's really tooting the horn of our members and the people who do the hard work to help us here in DC. So it's both a we did this, but also it's a you did this, and we want to make sure that they also feel the desire to celebrate what's a win for them.
I don't know if you're doing it on X because I'm not on there. I just get your emails, and that's gracious plenty.
Yeah, I'm not as good. I'm not, I'm not as, we are good. NBA is there, but I am not on X or, LinkedIn or Blue Sky or any of those things as much as it should be.
Justin, one of the things I did want you to talk about, and you mentioned briefly, but I'd like you to maybe talk a little bit more about it, is advocacy through amicus and other types of judicial kinds of advocacy, which I think is an area that, at least in my observation, is becoming more important than perhaps it was previously for trade association.
Yeah, no, I mean, do we have another 2 hours? We could definitely go into that. I think at a top line, what's important for the audience maybe to understand is NBA, when we look at our advocacy, tries to understand the most effective way to achieve our members' interests and shape the laws and regulations in ways that benefit them, consumers, in the marketplace, right? Increasingly, the forum to do that has become the judiciary, right? We don't need to do a seminar on administrative law, but I think the lawyers on this podcast would agree that the judiciary is increasingly asserting its power to interpret laws, interpret rules, interpret regulations, and in a post-Loper Bright era, almost be the final arbiter of the sufficiency and appropriateness of regulations. With that judicial, I won't say power grab, that'd be wrong, but with that judicial assertion of their importance in the constitutional order comes the need to advocate in the forum most likely to shape the law in ways that we think is appropriate. And that's why we've dramatically expanded our amicus brief program, because the courts are where a lot of the action is today.
Can you give us just a couple examples of that where you've done the amicus?
Yeah, so I mean, one case where we've gotten a lot of notice for doing amicus briefs, we're in the CFPB cases, right? Salia law, and then the CFSA case, where we did not weigh in on whether or not the CFPB's units, protections against removal were constitutional, or whether the CFPB's funding source was constitutional. But we did weigh in to make the very clear point that our constituents, our members, are, for lack of a better word, married to the CFPB by Dodd-Frank. And we need an agency capable of enforcing and interpreting those rules, because without that, we're sort of left with chaos, differing state interpretations, and a lot of unpleasant consequences. So that was one forum where we received a lot of notice for advocating for our members' interests. We also do it at the appellate court level. We've been involved in a lot of the redlining cases, including an amicus brief in the Townstone case, pointing out that we think the judge got it right on the ACOA merits there. And we're also involved in some class action stuff. Class action lawsuits, again, thinking of the forums where the law is shaped and kind of regulatory consequences actually come to bear. Class action lawsuits are a big one. So we just filed a brief. Unfortunately, the Supreme Court did not hear it. In the LabCorp case, arguing for a more rational class action certification structure where you throw out uninjured class members earlier, right? Because the problem now is some circuits say, well, we know that the uninjured class members that don't have a real injury, they can't be in here, but we'll deal with that later. Well, that's extremely coercive when you're faced with a gigantic class with the, somewhat uncertainty that, well, it'll be narrowed down later, but you're negotiating your possible settlement with this gigantic class that includes uninjured members. So we try to hit the whole. That was sort of a long answer touching on different points, but the summation would be, the courts are where the action is, so we try to represent our members' interests there.
I have two things. One, I just want to make sure when you said the judge got it right in Townstone, you were talking about the
district court,
not
judge,
the circuit court.
Yes, we wrote in support of the district court judge's opinion, and I think it's a brief people should read, because we also offered the appellate court a way to sort of read in the theory of redlining articulated by the Bureau in a way that more comports with the text of ACOA. But obviously, I am not a judge on the Seventh Circuit, and they disagreed.
And the second thing I want to highlight is you mentioned class actions, and I know I've seen a few comments in the chat about maybe talking a little bit about the Loan Depot LO Comp case, which is a class action. Essentially, the allegation there is that that Loan Depot misused the channel concept, I guess, to lower commissions, suggesting that it came in through a different channel, they can pay a different commission rate, and that was somehow misused. I certainly don't think we should discuss, whether that's true or not, but just any thoughts on the case, and if you can, whatever guidance you might have.
So when I first read the case, to me, it really underlined the need for one of the key changes the LO Comp rule NBA has been advocating for, which is allowing for competitive concessions, amending the rule to allow the loan officer to share in a pricing concession to keep the deal, right? A lot of times they've invested time and effort into this borrower, then it's later the borrower shops and says, hey, down the street they have a better deal. And now the only thing that can happen is the company either makes a concession and they can only do so much and remain profitable, or the deal walks because the LO can't reduce their compensation. Well, we think that should change. And I think this case is a perfect illustration of it. I mean, in some ways, it's kind of a perverse case, right? It's like this company was charging people less, and that's a problem in certain instances. I don't think that's how the free market, particularly a free market that incentivizes shopping as much as the mortgage market is, at least in theory, because of TRID's supposed to incentivize, should work. So, but that's my top line thought, is that it really argues for the need for a clear exemption from the rules from this. If there's, I'll leave it to others to opine on the individual circumstances. But to me, as an advocate in DC, it's even more evidence that we just need a clear and straightforward way to allow people to reduce their compensation.
Well, I did write about this in my most recent mortgage musings, so I'll leave it at that. my thoughts are there. Loretta or Peter, do you have any thoughts on it?
I would just say generally that I think that this is, a proposed class that hasn't been certified yet. And so I think if it does get certified, and you're, another lender in this space, that, don't be surprised if all of a sudden you get a lawsuit against you, from another plaintiff's attorney, because if, this is something that sort of sticks, at least in the certification phase, I think we're going to see more of these, regardless of any individualized practices.
I think the most interesting thing about the case is who brought it and perhaps why, but that again is maybe for another discussion.
Yeah,
And the flip side, Justin, as the LO comp rule is, we're always arguing, you're right, that we're doing this to help consumers and to not inconvenience a consumer who's this far down the path. And the same with LO, who maybe put their blood, sweat, and tears into that case. But obviously the way the regulators look at it and has been abundantly clear through the rulemaking is they're worried about the people who don't get those lower rates and the potential that people are some people are steered to those and others aren't. So again, coming back to the fair lending piece and how that might all play into it now under our current administration, where we're seeing DEI topple, and someone in the comments posted that HUD took down their translations today. So again, another interesting wrinkle in the fair lending landscape.
Yeah, I think that was Friday. So I was on vacation last week, so my timeline's good. I think that was Friday, or maybe even yesterday. No, yesterday I think it was, where they said they're no longer going to post translated documents, that they're only going to post in English for HUD. So yeah, that absolutely is somewhat breaking news. I mean, I think you're right, although I bristle a little bit, Loretta, because I've been having this argument since 2018, when people say if you allow pricing concessions, you'll have a fair lending problem. And my glib answer is, well, we're not proposing to amend the fair lending laws. So if you are granting pricing concessions in a way that creates a systemic pattern, or God forbid, your loan officers are like, I'm only going to cut my comp for, people that look like that. Yeah. That's still a Fair Housing Act violation, right? Like, LO comp aside.
And we know that that's where, even before the LO comp rule, that's one of the first places examiners would look. Let's see your exception report. And now I understand that as a means to look for improper change in loan channel classification for LO comp rule compliance, they're again starting with exception reports. So everybody out there, if you're not sure what to do now in a shifting fair lending landscape, I think it's still a good place to start, is your exception reports.
Yeah.
Well, I think we're already out of time, and I'm going to use my host prerogative to say that the LO comp rule again is a rule in search of a problem. We have fair lending; it's separate.
Yeah, I hope I have not come off as a defender of the LO comp rule. It is a bad rule.
No, you didn't.
That has very real anti-competitive effects.
No, and I understand the practical needs.
The statute is worse.
Amended and changing the arrow of regulation only goes in one direction, and that's more. So hopefully we can pull something back here. Anyway, thank you all. Thank you again to Polunsky Beitel Green for our sponsorship, and we'll see you all next month. Thanks, Justin.
Thanks, Justin,
Bye.
for
Thanks, everyone.
sharing.
Thank you all so much.
Bye-bye.